Hello, everyone. Today I'm going to have a very interesting interview with my lender and a friend, Andrew Kisada from Prime Equity Mortgage. You don't want to miss out this video because we're going to drop a lot of useful information. So if you are looking to buy or sell or refinance, this episode is for you. Thank you so much, Andrew, for being here.
Thank you for having me.
Yeah, absolutely. Andrew is with Prime Equity Mortgage, like I mentioned, 13 years in business. Hopefully, I see you 13 years more in business. I used Andrew in many transactions. He is one of my favorite lenders. So I'm going to ask him a few questions today to share his knowledge with you guys. So stay tuned. So my first question to you, Andrew, is the best question, which is, I want you to tell me the minimum down payments for certain loan programs, for example, VA, FHA, conventional, or any type of program that
Absolutely.
I didn't mention. So yes,
absolutely. So having gone through the business, one of the common, I think, mishaps is that borrowers think that they have to come in with an actual very, very large down,
which is not the
down
case.
Payment scenario, right? So we have programs where you do not need any money down, right? A no money down payment. It's much easier, if it's your first time buying, but that. There's challenges. There's credit challenges. There's income challenges, but down payment should not be one of the key hurdles, of to purchasing your property. So
Amazing.
VA, you don't need money down.
Okay.
If it's your first time, first use. If it's your second use, things, they might want some money down, some money, a 3% to 5% down even. On an FHA loan, 3.5 is the minimum down payment. But we have programs where you don't need to put any money down, right, on the FHA program, but the trade-off is that the interest rate and then payment,
it'll be higher. You might not qualify.
Exactly. And then with some of those programs, the down payment money is a grant. Some it's an actual loan, right? Some it's a loan. So both options work. And then also, let's say that the borrower has some of the down payment, but not all of it. You can also use gifted money, from family, friends. Family is
the number one.
Right.
Okay.
Exactly.
And which loan program is this? You could use, or all of them? Can you use with all of the programs? Okay.
Yeah, correct. All the programs.
Nice. And then when you get the information from the buyer, for example, or like the person who wants to do refinancing, how many vendors that you have in your contact list that you will send and choose the best for the buyers? How many are they? I know they are like in the tens.
For the program?
Like a lot of people.
Oh, okay, sure. Yeah. So my company, we're set up with over 50 plus wholesale conduits.
Nice.
So we have Rocket. We have some companies that are very big. Some of them not actually very big, but all the lenders follow guidelines. So what I would normally say is that we would build the borrower's file. Look at the income, the assets, the credit.
Okay.
And then we would make them a table. Here's option 1, 2, 3, 4, 5, and then once they have options, we would source which of the conduits basically have the best pricing, right, for that specific product.
That you will have less friction in getting the approval. Basically, you want to get them the approval.
Well, that and then and then also pricing. Which of these conduits can execute with with the best possible rates.
Okay, so it's you choose the conduit that will qualify the buyer, and also you choose the buyer for the conduit. They will give him the loan. So that's good to know.
Exactly.
Yeah, awesome. So my follow-up question is, I always like to know the difference between and I'm sure my viewers would like to know the difference between FHA and conventional loan, because I hear these two names a lot. Conventional is like the common, but sometimes people like to use FHA for like a lower down payment. So can you tell me the key differences between these two loan programs?
Yeah, sure. So FHA is a program governed by HUD. It's in history.
And what is the HUD for the viewers?
Housing and urban
development.
Correct. Yes. Sorry. Mm-hmm. So there's a handbook, and in the history, the program's meant for first time buyers. Mm-hmm. But you don't have to be a first time borrower to use it. It tends to be a little bit more laxed.
Okay.
The program comes with PMI, which is basically
what is PMI?
So good question. So basically the bank gives you the money, right?
Mm-hmm.
But the borrower pays an extra premium every single month. It's about $76 per each $100,000 borrowed. Roughly.
Oh, okay.
Roughly.
Mm-hmm.
And
that's good to know.
If the borrower defaults, that premium covers the lender. So the lender, is their actual losses are covered.
Substantial.
But it favors the lender, not necessarily the borrower.
The borrower.
Yeah.
Okay.
But big pros is that the guidelines tend to be a little bit more lax. The interest rate's lower.
Mm-hmm.
The ratios, most often, with the same down payment, you would be able to qualify for higher buying power with a FHA loan.
Okay.
Secondly, the FHA 580, is actually a minimum FICO score,
mm-hmm. which is very good, relaxed. Very relaxed, and opens up the doors for a lot of bigger pool, basically buyer pool.
So if you have a file that there's banks look at the income, the assets, the credit. If there's one of those areas that's a little bit not as strong, FHA most often is the way to go.
Okay.
And on the flip side, there's programs governed by Fannie Freddie.
Yes.
They have less fees. Their PMI tends to be cheaper.
Okay.
If
you
FICO
don't meet the
better.
20%.
Correct. And if the FICO score is strong, the PMI is lower.
Okay.
And it's just less wasteful, less fees, and but the parameters guidelines are very, very strict. You got to have credit, income, and then assets for the down payment.
Exactly.
Yeah.
Okay. Awesome.
And we offer clients options like I had mentioned, a table of options 1, 2, 3, 4, 5,
mm-hmm.
because oftentimes it's the property which will dictate which of these programs they would
can fund or utilize. Okay.
Exactly.
Sounds good. So my follow-up question would be, what is the term HELOC? I know a lot of people, they are I know what's the name and the meaning, but I want my audience to know.
Sure.
My goal is to educate my audience, and hopefully with your help they can get that.
Sure.
So what is the definition? How do we get it? Who can use it?
Sure. So
whatever you like to tell us.
One of the good things about to own assets is that you could borrow off of the assets if
which is amazing,
right,
in the States.
Right. So think of a HELOC. It's actually a home equity line of credit,
mm-hmm.
and it's basically a credit card type of line which is tied to your home.
Mm-hmm.
Okay?
So it's a secured
by
credit
the
card,
right? Mm-hmm. Pros and cons. You could use it to, let's say, pay off debt. Use it to buy more
properties, which is your goal should be that.
Right.
Yeah.
And risk drives rate.
Okay.
So a credit line tied to property, banks tend to give that it's a safer product than a credit card. So the interest rate should be lower than a credit card. And I think it's good for quick.
Yes.
Like
you have
quick
to pay
needs.
it back.
Exactly. Now the risk is the interest rate on those HELOCs tends to be variable. So every single month the
With the market rate
changing. As of late there are some actual fixed rate products, but the fixed rates start at about 9% par rate.
Right now it's 9%.
Right. As of this current market.
And can you tell us what is the amount? How do you guys calculate the amount? How much HELOC amount that you could secure for, like, let's say $1 million home?
Okay.
And it has like a loan of 500, just like a rough example.
Okay, so if it's on the borrower's primary home,
yes,
we can go up to 95 loan to value.
LTV.
So on that, let's see here, on that scenario, the borrower would be able to get a credit line for 450.
Okay.
So they would have their actual first mortgage, $500,000. And
plus the 450
for 450, and you only use on the HELOC based on your usage, like a
exactly. You use it, you pay it back. You use it, you pay it back. And the drawback is it's like a credit card. If you use it, it'll bring down your score if you don't pay it back, or if you use it like more than 50% or whatever the value. For like, it's just like a credit card. If you utilize it high, then your credit score will go down. If you use it and pay it back, then it's perfect.
Correct.
Like your score will stay the same.
I don't know that to be true. If, like, let's say you have a HELOC for $10,000.
Yes.
If you charge all 10,000 of it, I don't think the detriment is the same, as if a credit card was maxed out.
Exactly. It's not
right?
the same. It's not the same, but it's gonna hurt your credit.
It's gonna hurt the FICO.
But not as bad as a credit. You are absolutely right. Okay. Yes. Yeah. So my my other good question, which I like to ask you, is, can you tell me the brackets of credit scores? Speaking of credit scores, what are the brackets? I know if someone is 580, maybe, then he will get that rate. Then there is another bracket. Then all the way to whatever the highest, the 800.
Sure. So broadly,
yes,
580 to 639 is pretty much seen as bad credit. Poor credit. 640 to about 700 is seen as fair. 700 to plus is good.
Considered good
credit. But the pricing matrix.
Yes.
It's basically like every 20 points there's a pricing adjustment.
Oh.
So from 580 to
600
to like 599.
Yes.
That's one tier. 600 to 620.
Okay.
That's one tier.
Okay.
And
every
20 points there's a hit to the pricing.
Yeah, I did not know that.
Yeah.
Thank you so much for sharing.
Risk is going to drive the interest rate. So FICO is just one aspect to it.
Yes.
But in theory, you could have a low score, but an actual very, very strong down payment, and that might still put you, in the best case scenario rate.
Oh, okay.
Yeah.
So down payment plays a role as well, not only the credit score.
Sure.
Okay. So Andrew, I wanted to ask you this question. Sure. If someone is on the fence and they don't want to buy, or they don't think they are ready to buy, what kind of advice as a lender you can give them now to get the ball rolling, like to give them the energy and a push to motivate them?
Well, I would say you have to really work with your broker.
Okay.
And game plan your buy box. Okay. I want this house, this price in this area, right? I don't want to go past this street, this street, this street. This is my area here. The price point have to have, you know, if it's 4 bedrooms, 3 bedrooms. So that's your buy box, and then work with your lender to game plan, you know, to action plan. Every file has you know its own character, its own challenges. Very rarely does a file come in perfectly packaged. You know, banks are going to look at income, assets, credit. So income, you know, banks are going to look at your tax filings, pay stubs, right? Was there time off? Is there anything you can do right now to bolster your borrowing power? You know, by, let's just say, you know, if you work some more hours on overtime.
Yeah.
Items like, you know, credit.
If you are on a commission, just get like
if you're
more.
on a commission draw, yeah, right. So it kind of takes planning. Credit's big too. If your FICO score is 759, if we can get you 1 extra point, the interest rate's better.
Mm-hmm.
So plan for it now. And then assets, money, you could use your own money, stocks, IRAs, gifted funds from family. You can borrow money off of your IRA also for your 401k. So this all takes planning. So when and if that property comes up, you can execute quickly on an offer, because it's not who wants the house, right? It's actually who's ready to execute quickly.
Okay. Awesome. I totally agree. So I have a follow-up question to that. What do you see the common roadblocks, Andrew, when like issuing loans to people, and you've been doing this for a long time in your business? What kind of like the problems that people see on an everyday, and
I think
how to avoid them?
Right. So my trade is lending, right?
Mm-hmm.
And it takes work. A lot of people in this business, if you're not ready right now, this minute, they're not gonna. It takes more work to work with you, and then help you through your hurdle. So
Mm-hmm.
I've had clients come in with a credit score 550, 550, which is under the qualifying benchmark 580. Most places you go in and you would get turned down. We would put you on a customized action plan. Do this, and this, and when you hit 580,
then you're ready to go.
You are qualified.
Okay.
Money, some clients think because they don't have access to capital funds that they can't buy, but they haven't really been offered grant programs to help them with their down payment. So just like just like with anything else, doctors, lawyers, not everyone is going to give you the actual same counsel, and it's your job, as the borrower, to exercise all of your options and then find out which is going to be the best for your scenario.
Awesome. That's why I recommend for the viewers, if you are not in the hands of a good lender, I think you are missing out a lot. So Andrew, I have a question. I get a lot of buyers. They delay getting approvals from a lender because they say, "Oh, we couldn't find the property that we like." What advice do you give them to be ready and not lose the property that might come tomorrow? Because I have deals comes all the time, and sometimes within 1 or 2 days they lose the deal.
Right.
So what advice do you give to those people, those buyers, to make them be ready on time?
No, sure. So I would say it's, if you're thinking about buying a property, it's worth taking the drive to go meet with your lender and then agent, and just be very, very clear. This is the property. If it comes up right now, right, I will buy it.
Okay.
The price point, the area, the terms, and your agent and then your lender can basically be ready
Work together.
Exactly. So that when properties come up, you'll basically be the first call.
The first call. But before doing that, they need to talk to you, get a pre-approval at least, get the ball rolling when it comes to funding.
Exactly.
So to me, when I want to submit an offer, then it's very easy. I have your pre-approval, I have your buy box, I have your buying power. I submit an offer.
Correct.
Yeah, it makes sense.
On a tangent here, people that flip houses, right?
Yes.
How is it that they're flipping 2, 3, 4 houses every single month?
Okay.
Because in their orbit, they're known as buying properties that basically meet a actual certain
criteria.
Right, exactly.
Mm-hmm.
It's in this price point, it's in this area, and this is the max they're basically paying for it.
And you see them buying exactly at the same price within a certain
every
period.
Single month.
In the same area, maybe the same block sometimes.
Same count, right.
Yeah,
right. But it's every single month. It's because in their broker's mind, their agent's mind, they are top of mind.
Yeah.
So that they get the first call and they execute.
They get the first dips.
And their lender has their package ready.
Yeah.
And then makes the loan very quickly, right, without any hassles.
Yeah, I like that approach better than, okay, we're going to wait. When we see a property, we will talk to the lender. The lender maybe is not available or like not able to get a pre-approval quickly enough, and
Sure.
then they lose the property. I like the other way, that you are ready, you talk to the lender, you have a pre-approval in hand, and you're ready to go.
Right, exactly.
Yeah. So my last question to you, Andrew, is buyers always hear loan points. Can you explain what is a loan point?
Sure.
And why banks use it?
Sure. So like golf, par is even with the course, right?
Okay.
So rates, the par rate is a loan offered, right, without the borrower paying any points, right, for that loan.
Yes.
So let's say the current par rate is an actual let's say 5.99.
Okay.
So let's say the borrower wants to buy that rate lower. So say, you know what, I don't want a 5.99, I want a 5.5 because I could pay, right, X amount of thousands of dollars now, but I'm going to keep this home for 10 plus years. So the upfront fee brings the interest rate lower, and then every single month the payment is actually lower. So a point generally is a fee used to get the interest rate lower than the par rate.
Okay. Awesome. Thank you so much, Andrew. I hope you guys enjoyed this interview with Andrew. I did not learn some of the things in this, so I hope you enjoyed and learned something new. Thank you so much, Andrew.
Thank you, Dolf.
Appreciate it.
Thank you for having me.
Yeah, absolutely.